So today we're going to talk about how you use equity in a home to invest in property safely and effectively. If you bought a property, say 7 to 10 years ago in Sydney, you might have bought it for 500, now maybe it's worth $1 million or thereabouts. You might have started with a $450,000 loan and paid a bit off, and you've got all this equity. So what do you do with it? How do you use it effectively and safely? So let's imagine somebody does have a property that's just been recently revalued by a lender at $1 million. We've now increased the lending up to $800,000, but we already had a $400,000 loan. So what that means is the extra 400 is now the equity that's available. So if we keep the original loan at 400, take another loan of 400, but we haven't drawn that loan yet, you have a $400,000 loan with all this cash available in it in redraw. That's effectively cash that you can use to invest in other property, and there's some other things we can do to it to help improve safety and risk management. So let's say we think about what we're going to do with that 400. The first thing we normally recommend is we set up what we call a buffer. So if we take the first $100,000 of the 400 and we put that in another bank account that the bank considers an offset account, and we can talk about how you use offset accounts more later, but essentially what it means is if we draw that 100 and put that into the offset account offsets the interest from the 100, so we're still not paying interest on any money yet. The beauty of having an offset account as a buffer is that if for some reason you have a financial setback and you cannot meet the repayments, or meeting the repayments for a month or 2 or 3 would put you under pressure, you have this buffer of money that can continue to make the loan repayments and also help you out with any personal expenses for a period of time. So we always want to set up at least one buffer, and normally we recommend 2 when you're investing in property. So the first buffer is what we call a personal buffer. Whether it's $100,000 or $50,000 or a different amount, that's what we try and work out depending on your personal circumstances. So if the first $100,000 is used for personal buffer, out of the 400, we have $300,000 left. So what might we use that for? Well, if we split that 300 into a $50,000 amount and a $250,000 amount, the $50,000 we can use as what we call an investment buffer. So now we have 2 buffers. One we call the personal buffer and one we call the investment buffer. If we've got $50,000 as the investment buffer, we've got the other $250,000 left that we can use towards the deposit and costs for another investment property. So $250,000 is a 20% deposit plus about 5% costs for up to $1 million of property. Now you don't have to buy $1 million property, but it could be up to that with that amount of deposit without mortgage insurance. If we use a smaller deposit, we can actually buy more property. But if we use $1 million as a nice round number for now, but by all means, we could even reduce that to a $500,000, a $700,000, and $800,000 property. Now, if the $250,000 deposit and costs came from your home, the bank will lend you the other $800,000 needed against the property we're buying. So we borrowed the deposit and costs against your home, and then the other $800,000 against the property we're buying. So we've got $1,050,000 to buy the property and pay all the costs, such as stamp duty, lawyers' costs, all those sorts of things. So now we've got 2 buffers, enough deposit and costs for an investment property, and the extra borrowings for the investment property. So what do we do from here? Well, we can buy that property. So with some good advice, we can go and find a property up to $1 million in a growth area with a good rental return. Now, as we've got the 2 buffers set up, we can start to use the investment buffer as a management account for the investment property. And we set this up very much how you might set up a business. The investment property portfolio that we're starting to build is kind of a business. If you're going to set up a business, you want a cash reserve or a business overdraft to help you manage the peaks and troughs in cash flow. So if we've got that $50,000 buffer, we would then put the rent into the buffer and have the loan repayments and all other costs drawn out of the buffer. So now we don't need to worry if you have a month vacancy or a few weeks vacancy in rent, or that could even last up to a year, which you should almost never have in a good, well-located property. But now we can sleep well at night, knowing that we have this buffer of money as a cash reserve. What we also do is we will normally apply for a debit card, not a credit card. Credit cards destroy your borrowing capacity by about 10 times their limit. We want to set up a debit card that you can link to the offset account, so when you have other expenses that need to be paid, it can be paid with that debit card. And all the transactions we try and set up to run through this offset account, all the investment transactions. What we also do is we link up this management software system and accounting system to help you start to do all the numbers and the bookkeeping for your property portfolio. We have a software system called My Prosperity that links to all your bank accounts and all your loans and all your properties, so it can start to help us and you manage the property portfolio and help work out what the total cost is, help you do your tax returns and proactively manage the portfolio. Once we have that set up, it becomes really easy to manage and very safe. And that also sets you up to start thinking about your next properties. Once we have this $1 million investment property and your home, now you have double the amount of property and we don't need as much growth before we've got equity for the next 1 or 2 properties. So this is an excellent way to set up a property portfolio and to set up your whole lending structure to invest in property effectively and safely.